Okay, so we're going to talk about standard deviations. How do we draw them? What do they mean? And what is their purpose? So to begin, the kind of guide that we use for this is the Fibonacci. So ideally, what we want to do is set our Fibonacci settings to the ones in the screen right now. We want to have 0, 1, and these ones right here. I'm just going to leave it there for the screen to record it for a minute. Now, these are the settings we're going to be using with the Fibonacci to trace and measure the standard deviations that happen in price. Now, what is the purpose of this beautiful tool right here? The purpose is to use this as a tool for confluence over the direction that price may move towards, as well as the algorithmic movement it may do in between. Hence why we have a highlighted section in between all of these black lines. But how do we put this in price? Ideally, since price is fractal, you can put it in different variations. You can put it from the 1 minute, the 5 minute, the 15 minute, or even the hourly if you're aiming for a very large swing. But you draw it from the swing of manipulation. Now, what does that mean? Essentially, if we have something like this, where price manipulated to take out a liquidity before completely reversing towards the opposite direction, we measure it through the swing that was made. For example, this right here, the swing of manipulation. In live price, that looks similar to something like this. What did I remove? Right there. So we want to always measure the swing of manipulation from 1 to 0, the very high to the very bottom, in scenarios where we're looking for bullish price. When we're looking for bearish price, we do it very similar but opposite direction. The high to the low, the swing of manipulation right there. This is how we measure our standard deviations. Now, what is the meaning behind these little lines in between? Ideally, these are areas that you can use as targets where price is likely to hit and have a reaction from. So the best way to kind of use these is you want to kind of trail them where there's liquidity. How I use them is, for example, if I see that there's a 0.5 standard deviation from measuring the manipulative swing and I'm looking for shorts, let's see, is there any sell side liquidity that matches with this? Yes, there is, right here. So instead of looking to scale out my shorts at this sell side right here, I'll be focusing more in the one that confluences with the standard deviation. So this one right here. What about if there's no liquidity in between? Sometimes price or liquidity may be a bit more to the downside than you'd be anticipating for a target. But instead we could have, let's say, a PD array right here. Does that mean that we target the PD array alone? No, you could use the standard deviation as a confluence as well. Because many times, right, when price hits a PD array, you don't know if it's going to pivot from the very top, if it's going to pivot at the very 50%, or if it's going to pivot at the very bottom, or if it's going to pivot at all. You're kind of entering blindly, hoping that price is going to run right through it or pivot between the 50%. Standard deviations can also help in aiding in a target when it tries to basically pivot from this PD array. So if I was using the standard deviations for a short right here, I would be aiming to scale out here specifically once price hits this one standard deviation, just in case it were to pivot from as an additional target. Those are essentially the ways that we can use the ones in between. But what about this colored one right here? What does this one mean? Essentially, when price hits this zone, I like to think of it as a zone. When price hits the zone of 2 to 2.5 standard deviations, it is likely to do a retracement. So you could use this zone as an area where you can scale out majority or just scale out in general, or if you're looking for, let's say, a setup, you can use this as a confluence to tell you that price is likely to retrace right after. And the way that we kind of can combo a scenario like this is if, let's say, price hits this 2 standard deviation and you want to go short, but price is now all the way at a discounted level, so you're going to wait for it to go into a premium. So the way that we can do that is by using our other fib, premium to discount. And you can see that from the very swing, price essentially came all the way to OTE first before selling off once again. So instead of FOMOing into a short right here to try and catch the move lower, let's say price pivoted from here, you're expecting it to retrace here to do this. Instead of catching this mistake right here, you could use it as a confluence to, okay, it hit the 2 to 2.5 standard deviation. It is likely going to retrace to a premium. I can wait for price to retrace to a premium. And if it in fact does, I can use a PDRA, for example, this 1 minute CIVI, as my entry point for the move lower to the 4th standard deviation. The way that we kind of combo it is if price hits the 2 to 2.5, you can expect retracement and then continuation to the 4th standard. Ideally, the 4th standard is supposed to be the very extremity that price might pursue, especially if it has liquidity right on board it with it. So in this case, the sell side liquidity was right here. So my expectation would be that if I entered short here, it would have tapped the 4th standard deviation. Now in this example right here, price didn't tap it, but it was very close and could have been used for confluence either way to try and tap it before reversing completely. That's sort of how we combo with the standard deviations. In this case, this was the bearish price action of it doing that. But let's see with a bullish example, right? Let's measure with the one that we had right here. So if we measure from the manipulative swing again, we can see that our standard deviations go pretty high up. Does that mean that Nasdaq is going to go to the 4th standard deviation all the way up here? Not necessarily, but it helps guide ourselves in how price could go, especially towards these areas before expecting a sell-off. So since we have 2-point standard deviation zone here, perhaps price is going to try reaching here before selling off. Ideally, you do want to use it in 5-minute, 15-minute, and 1 hour to determine large swings, but you can also use it in the 1 minute. In this case, this would be the manipulative swing, so we would measure it from here to here. And as you can see, 1 minute time frame wise, price shot all the way up till it reached the 2 to 2.5 standard deviation zone, retraced, and then continued going higher until it hit the 4th standard deviation right here. So if you were trading with the standard deviations as confluence, this would be your target with the 4th standard deviation. And if you were bullish bias, you could also use the fib premium to discount. You can see that price hit equilibrium. So price essentially came from a premium all the way to discounted levels before continuing all the way to the 4th standard. This is how we can kind of use it as a measurement and as a little combo of using both fibs to determine the draw and to also give you that little confidence of holding through. And it works both ways. Let's say you want to go long, but you're not sure how far price can go towards the downside. If we measure the swing of manipulation from right here, where does the price stop hitting towards the downside? Right at the 4th standard deviation right here. So if price was selling off against you and you're not sure how far it can go before potentially going up, we can see that price, the moment it hit 4th, took out that low, it started pushing upward. So that's a little additional move right there. Any questions? The 0.5C between the 1 and the 0 is a possible LSR, LRB level that I have. Yeah, you could use it as also that. You could also put them all in one. the fib setting that I have for the premium and discount fib, I kind of have it as an all-in-one. I've already practiced so much with it that I have it like engraved in my mind. But the way that you can do it is if you measure the manipulative swing, for example, this one right here, which would be the 5-minute one, you can see how price came from a premium to a discount before dropping all the way to 0.5 and eventually 1. And if you go to the 5-minute, you'll see that that should be the swing right there. Yes, this is being recorded. You can find those live. The manipulative swing is essentially this drawn out. So imagine it like the beginning of a 2022 model. There's the raid, and then there's the market structure shift. What you want to measure every single time is going to be, what you want to measure in between is always going to be the low and the high of right here. So you want to measure this area and this area. The way that it looks like in price is like this. So, like I said, imagine it like the beginning of a 2022 model. You have the raid, and then you have the shift. This is the manipulative swing. If you see this happen, this whole process, you know to measure the standard deviation from the bottom to the top, like this. Let me just color out the where was it? There we go. So from 1 to 0. Do I know why it's drawn that way? Because ICT drew it that way. Can you show the settings again? Of course, Barbies. So these are the settings I have for the standard deviation. I will take a picture and post it in the chat. Is there a specific way to tell the difference between the leg of manipulation versus the leg of continuation? Do you mean... By leg of continuation, do you mean when price starts to distribute towards the opposite direction? Or when price just does a leg of distribution lower, as in if it was in a market maker sell model? Because ideally, when I say the leg of manipulation is when price does this process and kind of reverses right off. So for example, right here, we'll be measuring the standard deviation from here to here. I meant like our AGO 8 to 45, 8:55, that leg. I meant like an hour ago, 8:45 to 8:55 p.m. Is that a leg of manipulation? Let's see. Oh, I have it in a 24-hour clock. Let's switch real quick. So you mean this would be our leg of manipulation right here. This was the high, this was the low, this was the raid, this was the shift. The simplest way to identify it visually is just to, like, try and picture it as the beginning of a 2022 model. The moment it does that fraction of, or that part, you can just measure it as the manipulative leg. I caught the tail end. When price reaches 2.5 SD move, you look for 50% retracement for a move to 4 standard deviation? Yes. So ideally, when price hits the 2 to 2.5, you expect a retracement. The extent of the retracement, I like to look for it to in the scenario of premium to discount. So if we're all the way up here, I would want price to retrace to a discounted level for continuation to the fourth standard deviation. But it doesn't necessarily do that all the time. In this case, for example, the retracement it did after it hit the 2-point standard deviation was all the way to this 1 minute order block, and then it started to expand to what looks like to be the 4 standard deviation right here. I think it might hit it at any point. But you could have definitely used this as a confluence to, let's say, oh man, price is too high up. I'm going to wait for it to retrace down first before looking for longs. After it hit this, retraced here, oh, it respected it. Crap, I'll give it a shot to go long now that I know that it is likely to go to the 4th standard deviation. And yes, you do measure it from wick to wick. As Adrian has demonstrated his template. Thank you, Adrian. That's a good template to have right there. How would you do this in real time? Well, see, there it is. Hit the 4th standard deviation right there. So real time, it's pretty simple. If depending on what time frame you're watching, be it the 5 minute or the 1 minute, when you see essentially price do the process of this, that's where you can measure it from here to here. Similarly to that diagram that Adrian has given or posted in the chat, whenever you see price do that exact process right there, that is how you can measure it from 0 to 1. Yeah, eventually. Funny enough, this ended up hitting the 4th standard deviation right there, and I did it pretty beautifully. You can see that swing of manipulative swing, distribution through the standard deviations right here, hit 2.5 to 2 point zone, retrace to a PD rate, and then continue till it hit 4. That's ideally how we want to see it happen all the time. And I think that Friedent and Adrian are big users of them. So if you guys look at their little sections, you can see plenty of examples of them posting charts with it, especially Adrian. Yes, in this scenario, you would measure from here to here. In a bearish occasion, you could use, for example, what was that nice bearish example we had over here? What was this one? Here's a little example. So this would be a very small time frame one, but you see how there was a raid here? So price made the raid, then price made a distributive move down. This was a swing, measure from the high to the bottom, and this is our this was a good example. So you can see that price, the moment it hit 2 to 2.5 standard deviation zone, retraced, and then went in pursuit for the 4th standard deviation down here. So this would have been a good example of using in the 1 minute time frame to catch a short. You can use it in all time frames. I'd say it has good results in the 1 minute. You can also use it for OTE. Ideally, I would recommend, from my personal experience, using it in the 1 minute and the 5 minute. I'm pretty sure other people have their little kinks with it. OTE is like the premium to discount fib that I have right here. So it's these lines that price is optimal trade entry. So price is likely in the swing of distribution. It is likely to retrace here to equilibrium, or here, or here, or here, before doing the move. So measuring let me just draw out the 0 and 1 again. So in this swing of distribution, measuring from the high to the bottom, we can see that price went from a discounted level to a premium and hit OTE, which is the optimal trade entry areas. 0.7, 0.75, and 62 before selling off to 4 standard deviation. Yes, 2 to 2.5 is the sweet spot that we want to use. You can use it as confluences for targets, or you can use it for confluences as an area that price could retrace from. Yeah, this would be the settings for the fib with premium and discount. I'll post it right here. Upload failed. That's crazy. All right, well, there we go. So those are the settings I have for it. The reason this one is highlighted is because it's like a little golden zone. So I believe it's supposed to be like a little golden zone where the algorithm tends to react the most. So it could be used as a tool for risk syncing as well. You do your first entry at equilibrium, you do your second entry at OTE1, OTE2, and then OTE3. That's ideally how you could use it. I don't use it that way. I just kind of use it in sync with where the PD arrays are. So for example, let's say, there isn't one here, but let's say there's a fair value gap right here. If there was a fair value gap right here, and the OTE happens to be right here, I would be most likely waiting for this OTE to hit to enter the short, rather than entering here if there's no PD array. That's how I use it. Any other question? Or Adrian, if you feel like I missed out on something, would you like to share? Because I know you're a big user of this. What's my favorite confirmation to use to apply the standard deviation fib? Ideally, you want to kind of trail it whenever there's levels of manipulations. I don't do it in my charts because I've done it so much that I have it like kind of visually in my head of how the extension it does. But ideally, you do just kind of measure it wherever. The way that I use it mostly is I focus more in the 2 to 2.5 standard deviation zone as my retracements, because I do like to do retracement trades, as you guys have seen most times that I do take those kind of retracements. And I use them as a sense of where price can pivot from. Or if I'm looking for continuation, so for example, I watch this happen, I'm like, okay, well, price could continue to the 4 standard deviations. So if we're in this area, I could look for a short that would confluence. So let's say we have this SIBI right, let's imagine as a bigger SIBI right here. And I know that we just did this process. I'd use this as my confluence that, okay, it's an extra confirmation that we might definitely come down here. And if there's many like targets, for example, we had a sell side right here, we had one right here. Between these two, which one do I target? I can aim to exit majority the moment the fourth hits, instead of this one or this one. There's another nice little graph. Yeah, that's ideally how you want to mix it up with the 2022 model as well. But I would encourage actually that you guys check Adrian's channel, because he has a ton of beautiful charts that have standard deviations on them, and hit his own trades with it as well, so you can get like an idea. Okay, so if that's all of the questions related to standard deviation, we can move to the next part. I don't see that Carl is here, so he wanted to talk about something specific. Can we go over time distortion examples? The way that I like to perceive time distortion is when indexes are doing the opposite of each other. So essentially, I like to see it as when an index is lying over the true incentive that it wants to do. And the easiest way to tell it's happening is, let's say Nasdaq is trending upwards, but ES is trying to trend downwards. You don't know which one is doing the real move, and at the same time it's too risky to, let's say, go short on ES when Nasdaq is pumping, because at any point ES could just reverse and start following NAS again. Or vice versa. Nasdaq could just reverse and start following ES again. So I think that the best sort of idea to keep in mind is whenever you see the indexes doing opposite from each other, there is time distortion. It is simply the fact that price for a set amount of time is going to be distorted, and all trades are going to be lower probability, or they're going to be rather choppy. Let's see if we can find an example. Usually it happens in the open. I believe it happened this morning with how I think it was ES that was trying to go lower and Nasdaq was just trying to go higher. What the? Yeah, so in this fragment from around 10 a.m. you can see that Nasdaq was shooting upward, but ES was trying to go lower. Let's see, 10:10. Oh no, ES was down here. It's hard to do it this way, but whenever you see it like happening visually during live action, the best example I can give is this drawn out. Like if it's happening like this and the other one's doing that, that's time distortion right there. So ES making lower low and NQ making lower high is one example. I would say if imagine ES is making lower lows and Nasdaq is making higher highs. Because if it's the way that you're describing it, that would be an SMT. And it's just the fact that they're both trending. Imagine it like when YM, right? Let's say ES and Nasdaq are just dumping and YM is just randomly shooting upwards non-stop, full force. That is technically time distortion, but since YM tends to do it the most nowadays, you don't really consider it. But when it's between Nasdaq and ES, you do kind of consider it the most, because they ideally are like a pair, right? They're in sync. Even though there's like little divergences in price, they're still in sync in the overall draw that it is pursuing, either being upside or downside. For example, the 930 manipulation between NAS and ES, they still wanted to pursue lower, but they were different in the sense of how it manipulated to the upside. So 930, ES didn't really shoot up at all. ES didn't even take out buy side liquidity, but Nasdaq did shoot up and take out some buy side liquidity before selling off. That's just a slight divergence. Time distortion would be ES shoots down, but Nasdaq doesn't even budge towards the downside. Instead, Nasdaq just starts shooting or trending upward. Any other question? Alright then, gang. If that's all of the questions, then I think we're going to end this class like that. Tomorrow is Wednesday. We will be doing the backtesting session with gold. I hope you guys have a good rest of your night. This is recorded, so I will be posting it in my education section in a couple of hours. And I'll be seeing you guys tomorrow morning. Have a good night.